Good afternoon, everybody, and welcome to our latest webinar, our latest tax update, which today is a summary of the budget, which occurred on the 30th of October, as I'm sure you'll all be aware. This was Rachel Reeves' first budget, and it's the first Labour budget for over 14 years. Plenty in there for us to talk about. Overall, the budget was designed, or its aim was to raise about 40 billion in tax, and a large chunk of that, as you'll be aware, coming from the national insurance increase. But what we're going to do for the next 45 minutes or so is go through the various announcements that were made, some in more detail than others, because some are more relevant generally to ourselves and our clients. And hopefully you'll come away understanding a bit more about what was in there, what it means, what the implications are, and things you might want to consider doing in terms of your own affairs. As usual, there's myself, Vicky, who will do a private client update, and Robert, who will pick up some of the employment taxes matters. So I'll start off and just have a chat around the business tax updates. And so at a headline level, corporation tax, they're going to remain the same. And I'll come to a bit more detail on some of these on the following slides. Capital allowances, the 100% first year allowance on zero emission cars has been extended. R&D relief, as you were, it's going to be a transfer pricing consultation, and some creative industry tax reliefs that were announced in the spring budget in 2024 are going to continue as planned. So from a corporation tax perspective, pretty much as you were. Some changes to business rates. SDLT is going to increase by 2% for the surcharge on additional properties. An increase in the ATED charge, the annual tax envelope to dwellings, by 1.7%. And one of the hot topics in recent months, it was confirmed that VAT on private school fees will begin from January 25, although, as you may be aware, payments that have been made to date may also fall within those provisions. Well, firstly, it's probably worth just looking at that conundrum we often have to consider. How should we take profits out of a limited company? And Robert and Vicky will come into a bit more detail about the NI increase. But as you know, or one of the big headlines of the budget was the employer's NIC going up from 13.8 to 15%. So this is what it means very broadly from a profit extraction strategy perspective. And this is taking the sort of the usual scenario of comparing an unincorporated business and then comparing that with a limited company, if all the profits are extracted, or if all the extraction is done by way of a salary, or if we take a small salary and the balance in dividend. And here, small salary, what we're comparing here is taking the personal allowance, 12,570 as salary. Now you'll see the actual conclusion is that broadly the analysis is the same, in that the small salary and balancing dividend model does give a better result than just taking out a salary altogether. And the difference between the two is still, relatively meaningful until you get some, significant numbers. Once you get to 200, 250 and beyond, that's when the gap starts to narrow. So we are kind of in the same place as we were before, but clearly there is an additional cost now from the employer's NIC point of view in terms of taking a salary. And of course, with the small salary at 12,570, the employer's NI exposure on that is going to be increased now as well. So I thought it was worth just going through that just as an overview. Now, one thing we did get, or I suppose some good news coming out of the budget, was we do have some certainty around the corporation tax landscape over the next 5 years or for however long this Parliament may last. And a corporation tax roadmap was announced. And some of the things coming out of that, there's a commitment to keep the tax rates for corporation tax as they are now for the life of the Parliament. From a capital allowances perspective, retaining full expensing, the £1 million annual investment allowance, and the 100% FYA on zero emission cars. That's extended for another year till March 26. Now, there is going to be a consultation looking at simplifying capital allowances, whatever that might mean, and also the effectiveness of land remediation relief. From R&D, again, as you were there, so maintaining the current rates and the merged RDEC scheme. So as you may be aware, for county periods commencing 1st of April this year, we now have a merged scheme for R&D relief, although that's not strictly true because we do also have this still the enhancement for R&D intensive companies. The revenue are apparently looking at an R&D expert advisory panel by the end of the year, and this is part of their drive to tackle error and fraud in R&D claims. And we're also going to have a consultation looking at the use of advanced clearances for R&D. Now, there has been something similar in the past on this, but it was quite narrow in terms of when it could apply. It will be interesting to see what this might look like, and that's in spring next year when that's going to come out. A couple of other matters on the corporation tax roadmap. Transfer pricing, again, in spring next year, there's going to be a consultation on changes to the UK transfer pricing regime. One of the things that's been highlighted there is looking at the SME definition. And we might find that more companies are brought into the transfer pricing regime than at present, with the associated compliance costs of maintaining documentation and such like. At the moment, as you may be aware, small companies and SMEs are largely exempted from the transfer pricing requirements. And on the creative industry tax reliefs, the enhancement and extension of those is coming in as announced previously. Just want to touch on SDLT quickly as well. So from the day after budget, from the 31st of October, we have an increase in the additional dwelling surcharge by 2%. So it's going from 3% to 5%. So this is where you have a second property that's being acquired. Now, this will have an impact, or could have an impact, with people selling their main residences and buying a new house, whereby if the old house isn't sold, first of all, initially you have to pay the surcharge and then claim it back if the new house is bought within a period of time. The increase in the surcharge there clearly is going to have a cash flow implication. And there's an increase in the rate for what are called non-natural persons acquiring dwellings worth more than £500,000. That's going to 17%. Classic case here is limited companies buying dwellings. Now, there are various reliefs there, one of which is if you let that property out to a third party, you're back into the normal rates of SDLT rather than that increase rate. Interestingly, there's no change to the non-resident surcharge. That stays exactly as it was. And from 1st of April next year, the 0% rate for SDLT on dwellings halves from £250,000 to £125,000. And there's going to be a reinstatement of the 2% band between £125,000 and £250,000. What does that mean? Well, just as an overview there, just showing you the rates were applicable from 31st of October 2024 with the new higher rate of SDLT. So this is showing the properties with the additional rate of SDLT. And then from the 1st of April 25, those will be the rates applicable for transactions from there onwards. Quickly want to touch on employee ownership trusts, which have been gathering more interest and more traction in recent years. So this is where you can sell shares in a trading company to an EOT, and so long as the various conditions, which are many, as long as they are met, that can be a 0% CGT disposal for the vendor. So quite attractive from that perspective. Lots of conditions that need to be met and hurdles that need to be overcome, but nevertheless something that has its place. There have been some relatively minor changes. There was a consultation earlier in the year, and most of the recommendations of that consultation have been now put into law. So there is an extension of the period in which CGT can be removed from the exemption can be removed from the original transaction if various conditions don't continue to be met. So that's being extended to 4 years now from the date of sale. The EOT has to be UK resident. The former owners of the selling business cannot control the EOT. I mean, I suspected, I thought that should have been the case anyway, but nevertheless, that's now been put into law. There was a little bit of ambiguity around the contributions from the trading company to the EOT. Most of these transactions were done on deferred terms, so the company would essentially settle that deferred consideration through its future profitability, and it was kind of taken as read that the contributions from the company to the EOT weren't taxable in the EOT, but that was never actually in law anywhere. It was just treated as so from practice. But now that is law now, so there's no ambiguity about that, no doubt about it. And finally, there will be now more disclosure required in the tax returns of vendors. So there'll be a lot more detail regarding the transaction, which will have to be disclosed in the tax return. Finally, I just wanted to quickly touch on VAT. As I mentioned, the VAT on private school fees is going ahead as planned. No rowing back from that. And also, there is going to be a consultation on the introduction of e-invoicing in the UK. Now, this is part of a global move to compulsory e-invoicing anyway, so not unexpected there, and bringing the UK in line with what's happening around the world. It will make VAT compliance a lot easier, and I think it's inevitable that something like that is coming along. So that's all I really wanted to talk about from a business tax perspective. I'll now hand you over to Robert, who will talk through some of the employment tax highlights of the budget. Thank you.
Thank you very much, Craig. Good overview there, as ever, lots to think about. Yes, so employment taxes headlines, that sort of content page there, if you like. That's what we're going to be just sort of discussing through today over the next 10 to 15 minutes. There are a number of sort of more minor sort of changes, if you like, that are coming out of the budget. We sort of condensed it down just on the basis that we felt that it may not be as relevant to the audience that we're sort of pitching to here. But if we just go on to the main topic, I guess, if you like, Craig, if you don't mind. Yes, so the big news: employers' national insurance has gone up 1.2%, or rather, it's going up from the 6th of April 2025. Now, not sure if anybody's actually crunched any numbers on this as of yet. We've done a sort of few models in the office here, and realistically speaking, if you kind of got 3 to 4 employees, or obviously if you've got more than that, the changes that have been announced are going to have an adverse effect on the amount of national insurance that you're going to pay as an employer. But just to start with the lower earnings limit for employees anyway. I mean, we've got a slight increase in the lower earnings limit from 6th of April 25. It's currently £123 a week. It's going up to £125 per week. The government has confirmed that the primary sort of national insurance threshold upper earnings limit is going to remain frozen until the 6th of April 2028. What that kind of means is the government is hoping for effectively the fiscal drag, employees' salaries going up in line with inflation is going to actually increase their collection of national insurance receipts. But quite clearly, of course, that is relying on salaries going up. And if we kind of come on to the next point here, Craig, sorry, go back one, my fault. Will actually the increase in the employers' national insurance rate, will that actually sort of forestall any kind of increases or planned increases to employees' salaries that may have been predicted or even anticipated? As I sort of mentioned, we've got a 1.2% increase as of 6th of April 2025. The secondary threshold itself is actually dropping from currently 9,100 down to £5,000. So if you think about that, if you've got client or a business that you operate yourself, you've got a number of part-time employees or sort of seasonal workers that at the moment their total annual salary does not hit the current threshold, then we would need to be having a think about that and reviewing it, because more likely than not they are now going to be caught out, and that's going to mean you're going to have to be paying additional employers' national insurance on sort of previously, if you like, kind of exempt salary, if that makes sense. I guess some a bit of good news in some respects. Noting, of course, I was sort of saying, when you actually do the number crunching, it doesn't necessarily always work out that way. If you like this kind of tax-free employment allowance, so you get sort of £5,000 knocked off your employer's national insurance bill, subject to certain conditions at the moment. That's been increased to £10,500. And also there was a cap that, if your total bill for the entire accounting period is more than, tax year is more than £100,000, then you can get this allowance at all. But now that will apply to just about any business. And when I say just about any business, this will not apply, this employment allowance, to the vast majority of sort of single shareholder director companies. And that's going to affect sort of a lot of contractors. So those people who left the workforce for, if you like, maybe a better quality of life and more flexible working, fitting around sort of the school run and such like, we may well see a number of those people actually winding down their business and going back into full-time employment. Just because it's not going to be, feasible for them to continue going, really. Just one more point, if we don't mind, on this aspect. Obviously, the employer's threshold has dropped, but the qualifying year, if you like, for state pension purposes still remains £6,500. So typically, it would be sort of, just to touch on what Craig was discussing earlier on his slide in relation to profit extraction, you would set a relatively low salary, potentially down as low as £6,500, and then top up the rest with dividends. However, keeping that in the loop with the state pension requirements, that's effectively going to incur an employer's national insurance cost of £225 per year. So, of course, the threshold is much lower than the minimum requirement, if you like, for state pension purposes. So, regardless of where we think we might be, it's now the time really to start having a big think about reviewing the payments and structures as an overall basis. Which kind of brings me on to what other options are there if people are concerned. We're seeing quite a bit of a rise, I think it's fair to say, Craig, in sort of employee shareholder status. We've been implementing a lot of sort of EMI schemes and CSOP schemes for sort of the top managers, top senior managers, if you like, for a number of our clients. Will that kind of increase? Will that be in lieu of an increase in salary, offering them equity, for example? The danger there, of course, is if you can kind of consider whether or not the idea of that would be to pay them a dividend through their employee shareholder status. HMRC can see that indeed as being akin to a salary effectively and tax it accordingly. So something to be aware of. Salary sacrifices, sort of season ticket loans, are they going to be offered more again in lieu of a rise in salary? Got for things like for the hospitality sector, the trunk system in relation to payments of tips. There is a national insurance benefit in relation to that. And I think so one point would be to be aware of the rise of some, should we say, interesting schemes that people might offer to overcome this potential sort of increase in tax payable. As ever, any kind of rise in taxes, there's normally speaking going to be an increase in tax avoidance schemes that people may want to promote, and clients may well get wind of and ask you for advice. On to the next slide, please, Craig. So I'm going to touch a huge amount on this, but it kind of ties back into the previous sort of, discussion around the increase in the national insurance rates. Combined with that, of course, the national living wage and national minimum wage is going up. The national living wage for those 21 or older, as of 6th of April 2025, is basically going up by 6.7% if you sort of do the maths. For those people sort of in the 18 to 20 bracket, that's sort of going up by quite a significant 16.2% even. That is quite a the biggest rise that we've seen in recent history, to be perfectly honest. And again, more protection for under 18s and the apprentice rates. I mean, we're seeing an increase there of 18% from 24-25 moving through to 25-26. Next slide, please, Craig. I think this is something that we were aware of. There have been a huge number of umbrella type companies, and HMRC's concern has always been that the reporting of those companies has been insufficient to the extent that actually there's been an awful lot of tax avoidance used behind the scenes in relation to that. I mean, clearly, of course, there are a large number of legitimate umbrella companies, and they do work very, very well for the sort of contract sector where employers do need short-term staff for a short period of time. Broadly speaking, HMRC are going to push the obligation of reporting and paying pay as you earn back onto the, if you like, the end user, i.e., our clients who are actually sort of taking on those contracting staff, unless, of course, there is some sort of recruitment consultancy involved in the supply chain, basically. So again, it's a good opportunity to have a think about the supply chains of our clients and see if there's anybody that's going to be, potentially sort of caught out by that, because if it's really a question of the fact they just sort of mistakenly not reported it, then HMRC aren't going to look overly kindly in relation to that. But this is one of those measures where we haven't quite got the full guidance as of yet as to how that's going to work. So we'll be having a look at that into 2025 to see exactly how that's going to work in practice. I think this is something that we were aware of as well, really. In fact, the last government had sort of reported that this was going to be something that they're going to be looking at. The idea is to make the system of benefits provided by employers to employees much simpler from a reporting perspective. But realistically speaking, what it actually means is they're collecting tax each month as opposed to collecting tax once a year. So I guess from their perspective, better from a budgetary perspective. Again, unfortunately, it's not something we've got a huge amount of guidance on as of yet. Reminds us a little bit of the Making Tax Digital. It's been long touted, but nobody actually really knows how it's going to work as yet. And it's probably going to be drops in the soil from a great height. So it's just something that we just need to be keeping on top of and being aware of. Certainly speaking, when we get any further information in relation to that, we will be advising anybody of any changes that might be required and any reviews as may be necessary. Interest rates, effectively broadly speaking, with regards to the official rate of interest, which is used for, more often not sort of employer-provided living accommodation, but more specifically, I guess, more commonly, beneficial loans. If there is an official rate of interest paid on a beneficial loan, then there shouldn't be a benefit in kind. That's now been set for about 2.25%. We are advised that the government will be looking at the official rate of interest from the 6th of April next year, and they will probably be looking at it again on a quarterly basis. And again, it's one of those we just have to kind of wait and see what happens in relation to that. But I guess the more starkly is late payment interest on tax liabilities going up by a fairly substantial 1.5%. And of course, those of us that are aware of this, when you owe HMRC money, you end up paying a hell of a lot more. But when they owe you money, they can sit on it for months and months and months, and they pay you a measly 2.5% really there, or 1% in this case, actually. So again, that's just something that we just need to kind of mention to our clients, I guess. Those of our clients that maybe are always a little bit late in paying and maybe need a little bit of geeing up for that. There is now a slightly greater kind of significance to be able to get them paid up quicker. Yeah, it's taxation of company cars. Van benefit charge has now gone up from, what's 3,960. It's going to go up to 4,020. Van fuel benefit charge has been increased from 757 up to 769. This is all from the 6th of April 25. Car fuel benefit multiplier going up slightly again, 27,800 at the moment. It's going to go up to 28,200. Craig just sort of mentioned there in relation to electric vehicles, the government is extending the availability of first year allowances up until the 31st of March 2026. So again, just a bit more of an incentive there to get electric cars, get petrol diesel cars off the road. But the actual sort of benefit in kind calculation rates are going up slightly as well. Double cab pickups. You may obviously remember the debacle that we've had, this year actually really, wasn't it? But the double cab pickup, which was the stalwart of the sort of farmer's vehicle, previously sort of classified as sort of works vehicle, commercial vehicle, in which case the van rates of for benefits in kind would be applicable. The Conservative government said, no, we don't accept that. So if it's got a double cab pickup with passenger seats in the back, we're going to classify it as a car. And then I think it was within 24 hours, they then decided to change their minds. And I believe that was because Rishi Sunak was due to present to the Farmers Union that day. And I think it was slightly frightening. It was going to be chucked into a combine harvester if he had kept it as planned. But if you looked at the news fairly recently, it's like Mr. Starmer's going to be chucked into a combine harvester, which Vicky will be telling you all about in her section. Next slide, please, Craig. So something I'm not going to touch upon a huge amount because it's probably not vastly sort of relevant to types of clients that we're dealing with, but has been a slight change to a certain type of international pension scheme. It's been around for years, qualifying recognised overseas pension scheme, which sounds sort of fairly grand. Very, very useful if you've got a sort of wealthy client with a large kind of paid up UK pension pot, and they were planning to retire in a nice sunny climate like Spain. Broadly speaking, they could transfer their sort of entire UK pension pot into a CUROPS, as I just sort of mentioned there, in the European Economic Area or Gibraltar for that matter. And they would not actually have any tax obligation in relation to that. It would just be a straight transfer. Government's now decided they don't like that, and anybody that's in that position, they are going to charge a 25% tax on the value of the pension pot that's being moved over into the CUROPS. And again, probably not overly relevant, but just something to be aware of if one of the clients that you're actually looking at, their financial advisor has recommended setting up a CUROPS for one of your clients. And just very, very briefly speaking there, I mean, the expression CUROPS qualifying recognised overseas pension schemes. There are, of course, other overseas pension schemes available. The government is now going to bring those in line and actually sort of treat those as qualifying if they meet certain qualifications, or else they are still going to be classed as non-qualifying, in which case there's going to be additional sort of tax burdens and obligations in relation to that. And I believe that was all I had to say on that. So thank you very much.
Good afternoon, everyone. I'm going to be talking to you about the private client aspects that came out of the budget. And I think it's fair to say that other than the national insurance, the employer's national insurance, it's in the private client arena it's been quite a lot of publicity. So I'm going to give you some of the headlines first, and then obviously go into more detail on certain aspects, in particular the inheritance tax changes and the capital gains ones. So just as a reminder, the income tax thresholds have remained, and there has been the announcement, which is a welcome announcement, that they will actually start to increase in line with inflation from April 2028. I think when Rachel Reeves was giving her budget statement, everyone was expecting that it would carry on up until 2030. So that is a favourable outcome, albeit a relatively modest one. There's still the freeze on the starting rate for savings income. The employee national insurance rates remain at the reduced amounts that were announced by Jeremy Hunt in his last budget. ISA allowances remain. Now, there are some welcome aspects. There were various different predictions as to what was going to be in the budget, and there are some things that weren't changed, which were expected to. So there have been no changes made to the rate of relief on pension contributions. Neither has there been national insurance added in terms of employer national insurance on pension contributions, so that's welcome. And there's been no reduction in the amount of pension lump sum allowance that you can take out, the 25% tax-free allowance. So that still remains at the 268,275 level. Now, in terms of inheritance tax, I'm going to come back to these aspects in more detail. So just carrying on with the headlines. I'll do the capital gains tax in detail as well. There have been some increases to carried interest rates, but I don't think that has a general application, so we're not going into detail there. Employee ownership trusts, Craig's touched on those. I'll come back to the changes to the treatment of foreign income and gains. We've discussed a lot in previous professional tax updates about the fact that the furnished holiday lettings regime is being abolished from the 6th of April. So again, we're not going into detail here. There has been some more detail on that, but the main points of it have been done in previous versions of this. As Robert mentioned, interest on late payments of tax is being increased by 1.5% from the 6th of April. And the final bullet point on this slide is one that wasn't welcome. There had been talk that the high income child benefit charge would be based on household income to try and make it fairer. And it's been announced that that isn't going to take place. It's still going to be based on each individual as personal circumstances, which means there are disadvantages for single parents. So going into the detail here a bit more. So this slide is just confirming the freeze of the starting rate for savings income, the freezing of the rates for ISAs, which includes lifetime ISAs and junior ISAs, and child trust fund allowances. And there is just one point here as well from a national insurance perspective for individuals, that there are a small number of individuals who may be impacted here, where you're looking at how they've taken salary, dividend, like Craig mentioned earlier. There will be a small number of those that will need to take a higher amount from April 2025 to stop being adversely impacted. And this is because they'll no longer be credited with national insurance contributions for state pension credit purposes if they keep at that lower level. So they will need to consider making voluntary national insurance contributions to make sure they continue to have a qualifying year towards their state pension to make sure that they get their maximum amount. So that's just something to bear in mind. So now we get into inheritance tax, and that is an area that has had significant changes in this budget. There were lots of thoughts as to what aspects could be changed, and obviously now we know a lot of the detail, albeit we don't know exactly how it's going to operate, and we are awaiting some more information in the new year. So there has been confirmed that the inheritance tax rates are going to be frozen for longer than had originally been stated. So they're now going to be frozen until the 5th of April 2030, which, just as a reminder, means that the standard nil rate band will remain at 325,000. and it has been at that level for a number of years. The residence nil rate band is staying at 175,000, and the amount where residence nil rate band starts to be tapered down is remaining at £2 million. So again, we're seeing the effect of fiscal drag here. Now, I didn't want to be all gloom and doom, so there is some welcome news that came out of the budget, and that welcome news is more that they didn't change some of the things which had been trailed as possibilities. So the 7-year survivorship period for lifetime gifts that anyone that sort of advises in inheritance tax will be aware of, that's remained the same. There hasn't been a cap introduced on the amount of lifetime gifts that somebody can give. Taper relief remains, which reduces the inheritance tax payable on gifts where there is inheritance tax to pay, but the donor has survived the gift by between 3 and 7 years. And one of the big areas is that there's been no changes to the regular gifts out of income exemption. So if you or your clients fall into this and you've got surplus after tax and expenditure income, then it is possible to gift that in a very tax efficient way without having to survive the 7-year period. So that is something that people will be looking at more, and I know there's been lots of discussion about that. And also, there still remains the uplift on death to the base cost of assets for capital gains tax purposes, which is very valuable. And that can make it easier to pass on assets on death without having to worry about capital gains tax. Now, since pensions haven't, up until recently, pensions haven't been within individuals' inheritance tax calculations, and that has meant that there's been focus on those in terms of inheritance tax planning, and people have tended to put amounts into their pensions, keep them there if they needed them, that was fine, but they have been a way of inheritance tax planning where your pension was the last pot that you used because you could pass it on tax efficiently without having to worry about inheritance tax. Unfortunately, that system is coming to an end from the 6th of April 2027. And that is a big change and is likely to be very costly for a number of people. That means that unused pension funds and also death benefits from discretionary schemes will be treated as part of the deceased estate. Now, that brings it in line with other schemes where you don't have that flexibility. So for people with SIPs and personal pension schemes that you don't have to take an annuity on and therefore have value remaining after you've died, we'll see a big change to their inheritance tax exposure from the 6th of April 2027. It also brings in administrative burdens and complexities, which could lead to time delays, because pension scheme administrators will be required to report and pay the IHT that's linked to their pots. And how that will actually work in practice is something that's being considered. Unfortunately, not only is it the bad news that the pension funds will be subject to inheritance tax, but it also means that the assets that count towards that 2 million threshold from the residence nil rate band have been expanded. So it's more likely that clients or you will lose the residence nil rate band, which increases the amount of inheritance tax you'll be paying on the rest of your estate. So it really does signal an end to the special treatment of pension pots on death. Wealthier individuals had kept surplus assets in their pension pots as part of their inheritance tax planning purposes and had spent down their other assets. And it does mean that over the next few years, it'll be important to review planning opportunities in the context of the whole estate, and to have various different advisors having advanced conversations and collaboration to see what's best for individuals. Now, HMRC have launched a 12-week technical consultation to look at this in more detail, and some of the key issues that are included are the interaction of inheritance tax and income tax, because that's something that people are keen to try and make sure that these are both avoided, to avoid them being levied on the same pension pot. And that's something that I'll come on to in the next slide to explain that more. And just I wanted to make sure that people are aware that wills have no effect on how somebody's pension pot would flow after their death. It's not something that a will directs, and so it is very important to have up-to-date expression of wishes linked to pensions as well. So just on the next slide here, just pointing out the taxes that can apply on pension pots now. And there is unfortunately now a potential triple death tax where a deceased individual dies over the age of 75 with an unused pension that has value to pass on to their beneficiaries. Not only will there be an inheritance tax liability on the pension, assuming that their estate has otherwise used the standard nil rate band. So that would be a 40% charge. And then because the individual that had that pension pot has died over the age of 75, there's also an income tax liability on the withdrawal of that pension, which would give a maximum 45% income tax rate. And looking at the two of those combined, that gives an effective tax rate of 67%, which is already quite high. And then, unfortunately, as I've said, the fact that pensions are included in your inheritance tax calculation means that you have to keep an eye on the residence nil rate band and whether that tapers away to nothing. And if it does taper away to nothing because you've got a significant pension pot, that means that you don't any longer qualify for that residence nil rate band. It has been estimated that the very worst case is that the effective rate of all these three taxes could be as high as 90%. Which is a considerable change to now, and obviously very unwelcome. And hopefully that's an area where there will be some clarity. And I think there's hope that there will be some acceptance that the income tax liability is unfair. But as a lot of us know, taxes aren't always fair. So we'll just have to wait to see what happens in that regard. So now moving on to another area where there's big changes. A lot of us are used to having always worked in tax and being aware that where you had assets that qualify for business property relief and agricultural property relief, often they were at rates of 100% and clients didn't have to worry about inheritance tax. Now this is changing. The first change that's coming in is from the 6th of April 2025, and that's a relatively modest but very welcome change to say that the scope of agricultural property relief is actually being extended. So more categories of assets will qualify for agricultural property relief, and that will now include land that's managed under an environmental agreement. Now, that environmental agreement has to be with specified parties, but it does mean that there's an acceptance that that land should qualify for some favourable release, which is good, because it had been an area of concern that it was disincentivising farmers entering into those because they were treated less favourably. Now, from the 6th of April 2026, there's this big change that business property relief and agricultural property relief will no longer be there at whatever level individuals want. The 100% rate for both combined agricultural property relief and business property relief will be capped and will only apply for the first £1 million of eligible assets, and it will be apportioned between them on a set basis. So there will just be £1 million worth of business and agricultural property at 100% over any other nil rate bands the individual has, and then the balance will be taxed at 50%. So effectively, that means that the effective tax rate on business property relief and agricultural property relief will become 20% going forwards, where the £1 million band's been used, which is a big difference. And there's lots of concern about how that would be funded and the impact it's going to have on passing assets down the generations. And in fact, I think the farmers have started protesting already at some of the conferences, and there's a protest happening tomorrow to highlight the changes that's happening, the effect it will have on passing farms down. Now, where assets are covered by this £1 million band, we're not sure exactly how that limit's going to work. We're not clear whether it's a lifetime limit, like the allowance we have for business asset disposal relief for capital gains tax purposes, or whether it'll be replenished every 7 years, like we used to happening within the usual gifting rules. So that's something to keep your eye on, and just remain cautious on if you're having discussions about how much that will be. Where people have got AIM listed shares, again, previously they've qualified for 100% business property relief where they've been held for at least 2 years and they're in trading companies. It's been announced that from the 6th of April 2026, that rate will no longer be 100%. It will be capped at 50% in all circumstances for listed shares designated as not listed on the markets of a recognised stock exchange. So that means that AIM listed shares will only ever get 50% relief, never 100, and you won't be able to use the £1 million allowance. So that will alter some inheritance tax planning. And where you've got property that currently only ever qualifies for 50% business property relief, those rules will stay the same. There's no changes to that, and they don't count towards the £1 million allowance. Another aspect just to bear in mind is that where an individual doesn't use their £1 million allowance, it's been announced that that will not be capable of being transferred to a surviving spouse for them to use. That is something that I think there's been representations on to say that that's not fair. But at the moment, you should realise that that £1 million allowance, if it's not used by the individual, is lost. And I guess that suggests that it could well be a lifetime allowance rather than refreshing every 7 years. Now, these changes to business property relief and agricultural property relief also impact trusts. And so from the 6th of April 2026, a trust will have a similarly combined agricultural property relief and business property relief allowance of £1 million for the trustees. And there are some anti-forestalling rules in this regard that I'll come on to in a minute. So very big changes here, aspects to keep an eye on, and we'll move on to the next slide, please, Craig. So these changes will have a very significant effect on a number of people. It will have an effect on the estates of people when they've died. It will have an effect on individuals making lifetime gifts of assets to individuals. It will affect putting assets into trust without an immediate inheritance tax charge. And it will affect trustees where the assets are already held in trust and they need to assess their exposure to inheritance tax during the lifetime of those trusts. And thinking here of discretionary trusts, where you get 10-year charges and exit charges where trust capital is paid out, because obviously these will have a big effect on cash flow. Now, I mentioned that as well as saying that these changes are coming in a couple of years, there were actually some anti-forestalling rules announced, and these apply to lifetime transfers that have been made between budget day and when these new rules come in. And so it appears that the new agricultural property relief and business property relief regime will apply to lifetime gifts made between these dates, where there's a chargeable event. So that means where the donor dies on or after the 6th of April 2026. If there's a lifetime transfer between these death dates and the individual actually dies before the 6th of April, the existing rules apply and they would benefit from the current 100% business property relief and agricultural property relief. But obviously, nobody has that crystal ball to know exactly when they're going to die. And there's an impact on trusts qualifying for these reliefs and the £1 million allowance. It seems that there's differences in treatment of that allowance, depending on whether the settlor created the multiple trusts before or after the 30th of October 2024. So if an individual had set up several trusts before budget day, then each of those trusts should get the £1 million allowance, so long as they're not related settlements or same-day settlements, which could be different. But if the individual sets up multiple trusts after the 30th of October, then the £1 million allowance would be spread across those trusts set up more recently. So again, we don't have all the detail. We're waiting for more information on this, and it's been said that there'll be more, I think, expected in spring 2025. But they are really big changes that are going to have a big effect on people and thinking about what they want to do. Now, as well as these inheritance tax changes that might encourage people to pass on assets in their lifetime, whereas it had been thought to be deathbed planning in the past, the changes to the business asset disposal capital gains tax rates that I'm coming on to shortly should be factored in as well, because those rates are going up in stages. So there may well be a pressure from clients to do some planning around these to try and limit the capital gains tax charges. But I would just caution that we don't have all the detail here yet. So unfortunately, some taxpayers will see their inheritance tax exposure increase very significantly. As I mentioned, larger estates will see their inheritance tax exposure increase by 20%. on death, because that's where they've got a lot of business property relief qualifying assets at the moment, and that will very much be limited in the future. And for trusts, they'll see a 3% charge every 10 years and on exits on the value of qualifying agricultural and business property over the £1 million allowance. There are numerous practical implications, and as I said, the government's committed to publishing more information in a technical consultation early in the new year. And they've said that that will focus on the detailed application of how that £1 million allowance will apply to lifetime transfers into trusts and the inheritance tax charges on trusts. What all of this means is that estate planning will need reviewing and lifetime giving revisited, and it may well mean that individuals start thinking about making gifts sooner than they would otherwise have done. There are opportunities to gift assets under the current rules before the 6th of April 2026. But as I say, they are subject to the anti-forestalling rules if the individual dies after the 6th of April 2026. I've mentioned that inability to transfer the £1 million allowance between spouses, and that may mean that married couples or civil partners think more about rebalancing who owns the qualifying assets during their lifetimes to make sure each of them can claim the £1 million rather than wasting that allowance. It's possible and likely that many individuals will need to review their wills to ensure that they make the best possible use of the available release from the 6th of April 2026, and that they capture the reduced rates that are available efficiently, and check that the way their wills are drafted allows for a 50% rate in agricultural property relief and business property relief to be efficiently captured. In terms of the fact that there'll be tax to pay on business property going forwards, it has been reiterated by Rachel Reeves and the government that it is possible to pay inheritance tax on business property in equal instalments, interest-free over 10 years, but there's still the cash flow problems in how you actually get those funds to actually do that. And another point here is that it's going to become important, the value of particular assets, whether they breach the £1 million allowance or not. So unfortunately, that's going to be an additional cost to individuals and estates, and it's going to become increasingly important to have those and have an appreciation of what levels there are there. And what this does mean is that whilst it can be expensive, life insurance may well play a bigger part in inheritance tax planning and thinking about how that inheritance tax will be paid in the future. So very much a collaboration needed between different advisors to help individuals plan this for the future and see how these, what options there are. Now, this slide is just summarising the capital gains tax changes. So there have been changes to the rates on budget day. These took effect. And again, whilst nobody ever likes tax rates to go up, I think people were pleasantly surprised that they hadn't gone up even further, because it had been trailed that they could go up as high as the income tax thresholds. So just as a reminder, for individuals, the lower rate of capital gains tax has increased from 10% to 18%, and the higher rate from 20 to 24%. And for trustees and personal representatives, the capital gains tax rates are the higher of those rates. So that means that for trustees, they've gone up from 20% to 24%. These rates are therefore brought in line with the capital gains tax rates that have already applied for residential property. So there's no changes to those. They remain at the 18% and 24% rates respectively for basic rate taxpayers and higher rate taxpayers. Now, as well as those rate changes, there have been some changes to business asset disposal relief and investors relief. Again, this is an area where it was expected that there could be changes, and in some ways it's welcome that there's any allowances here that remain for a while yet. So the rate for capital gains tax, where these reliefs apply, will increase on the 6th of April 2025. They'll go up from 10% to 14%. And then they'll increase again on the 6th of April 2026 to the 18% level. So it does give a bit of time for individuals that qualify for these and haven't already used the allowances to benefit from these at lower rates. Unfortunately, the lifetime limit for investors' relief is being reduced down to £1 million, which is quite a reduction from the £10 million that it was for all qualifying disposals made on or after budget day. So that's already happened. And so that's brought investors' relief in line with the limit for business asset disposal relief. And unfortunately, what was also announced in the budget is that those individuals qualifying for business asset disposal relief who've reorganised their share capital or entered in for share exchanges before the 30th of October budget day, that there are anti-forestalling rules that have been introduced. And if they hadn't already taken steps to elect out of that regime, it means that that's no longer possible. So the tax neutral rules will automatically apply, and they'll also apply to transactions taking place between the 30th of October and the 6th of April. So what that means is that people can't choose to manipulate the gains and pay the taxes at lower rates. They automatically just swap the shares for the other class and haven't triggered a capital gain. Then going into this in less detail, but wanted to make sure it was marked because it is a big change in the tax landscape. We've known that there were changes coming to the taxation of non-UK domiciled individuals since Jeremy Hunt's budget. But this is confirmation, and there is more detail on what those changes will be. So from the 6th of April 2025, the remittance basis of taxation that applies to non-UK domiciled individuals has been abolished, and it's being replaced with a residence-based regime. So for income tax and capital gains tax, we've got a new foreign income and gains regime. There's a temporary repatriation facility, and there will be an ability to rebase, but not to the value at the 6th of April 2025. It's an earlier date. They're big changes, and it's important for individuals that are caught by this to take specialist advice in advance of the 6th of April next year to make sure that they are aware of how they'll be impacted and whether there's any steps they should take to reorganise their affairs, or even if they were thinking of leaving the country, whether they want to do so before the 6th of April. Now, things that they could do if they're wanting to stay here include segregating their pre-5th of April income and gains from those applying afterwards. Now, as well as that, there are also big changes for inheritance tax coming. We're used to having had the concept of domicile here when we look at the scope of inheritance tax, but now it's going to be brought into a residence-based regime. And those who have been resident in the UK for 10 of the last 20 years, as well as their trust, will fall within the scope of UK inheritance tax on a worldwide basis. So this is very much bringing many more people into the UK inheritance tax net. And there will be a tail in terms of if somebody is caught by these rules, how long it will take them then to fall outside the scope of them if they choose to leave the UK and start becoming non-UK resident. So just something to bear in mind. I think usually as an audience, we don't tend to focus on the non-UK domiciled aspects, but just wanted to have it there as an awareness without going into too much detail. Now, finally, I feel like I've spoken for a long time here because there have been so many changes, but this is just a reminder that making tax digital is coming in. As Robert said, we've known about this for a while, but haven't had all the detail. So they have confirmed that making tax digital will be rolled out as announced. Individuals with gross self-employment and or rental income over 50,000 will have to do it from April 2026. And then there's a staged process for other individuals. And it has been announced that it will be extended to individuals who fall into these categories of income over £20,000 by the end of Parliament, but we don't know the precise timing of that at the moment. So I will pass back to Craig to see the questions and answers if there are any. And I thank you for listening, and obviously let us know if you've got any questions.
Thank you, Vicky, and thank you, Robert, for your valuable input into that. I think I do. Do we have one question? We do have a question. What monthly gross pay do you need to pay from April 26 in order to qualify for state pension? So this is the 6,500 figure, isn't it?
Correct.
So if I quickly get, so it's £6,500 per annum.
Yeah.
And so the monthly Can't do that one in my head, but yeah, 6,500 divided by 12. That's the that's the answer for that one. So this is where you do have this disconnect in that the NI limit starts at 5. So you do have a small employer's NI liability of about £225 in order to get to that £6,500 figure. So hopefully that answers that one. Is there a threshold for minimum number of employees before the increase in NI kicks in? There is no. It's a blanket rule. Obviously, they've increased the allowance to £10,500 and eliminated the £100,000 ceiling as such. But yeah, it applies to any business that employs people, unfortunately. So I hope that's answered those questions. Thank you for that one, Bradley. Yeah, now the webinar has been recorded, so you'll very shortly be receiving a link. So should you feel the need to watch us again, or want to remind yourself of any of the things we discussed, please look out for that email coming across. It'll be on our website as well, and our usual social media channels. Plenty to talk about there. Clearly, lots of big changes on IHT and such like. I just want to mention the non-dom changes that Vicky was talking about. Yeah, we don't come across it very often, but there are 103 pages of draft legislation for that. So that just shows you, how much detail there is going to be around that particular topic. So just remains me to say thank you all for listening. I hope you got something out of it, and dare I say, wish you a Merry Christmas. Is that too soon? Probably is. So we'll catch up again in February, March time. And thank you, and we'll see you all soon. Cheers.